Thank you. So I'm delighted today to be the moderator on this panel discussion around strategic financing, unlocking a new capital pipeline for natural resources projects. So before I start, just a few words on Marsh McLennan. So we are a global services specialist firm, a leader in risk and insurance, and we are actually the leading insurance broker in mining and metal on a global scale. So I will now quickly introduce the members of the panel. So starting on my right, so we have Mark Tyler. He's the London representative of Auramet, a 20-year-old full-service merchant bank trading in precious metals, and we have traded over 24 billion over the last year. Mark comes from a background in banking, development finance, and mineral processing technology. Then you have Alison Turner from VSA Capital. Alison advises the Umbono Global Mining Fund, a hedge fund investing primarily in listed small and mid-cap mining companies with a long-term time horizon, which she founded together with her partners in the US. So Alison has previously spent time in the industry with BHP Billiton. Then we have Thijs Terblanche, so Senior VP Business Development at Ausenco, a global consulting, engineering and construction management firm. Thijs is a mining specialist with significant experience in investment banking at Standard Bank and CIBC. And finally, Gervais Williams, Head of Equities at Premier Miton. He manages a number of funds and trusts that aggregate to over £1.5 billion. His fund management career extends over 30 years, including 17 years at Gartmore Group Limited. So to begin discussion, maybe one of the key concerns that have cropped up over the recent years relate to the current high inflationary environment. So what are your views around how to attract capital? And I'll turn first towards Mark.
Yeah, look, I think for the mining industry, the inflation has been less of a concern than it has been for other people. I think the industry's had the ability to deal with inflation in the past. And what we saw even at the worst of the inflationary times is the engineering companies, and Thijs can talk about it in more detail, the engineering companies had managed to get a cap on the inflation, so it wasn't uncontrolled. Investors knew that that was probably one of the lower risks in the project. It was properly managed, and the engineering companies had a handle on it, and so there was less concern about it, I think.
Thijs, maybe would you like? Oh.
Yeah, I think as Mark says, as we a little bit on at the coal face of a lot of the developments going on, I think the constraints in capital are really sitting in two buckets: financial capital and human capital. And I think on the financial side, yeah, we've seen cost inflation really impact a lot of projects. We've seen a lot of studies with pretty poor returns. A lot of people wondering whether this is the right time to actually put out a study, because the cost environment is clearly not conducive to show your project in the best light. At the same time, over the last couple of years, and I guess at the back end of COVID, it really was at its height. We saw a lot of projects suffering from that. We saw projects, capital budgets getting blown out, which is still the case. But for a lot of the more influential cost impacts, and in particular, that's the bulk materials that go into the construction: steel, concrete, cabling, piping, those kind of things. Certainly had a very high, went through its peak, I should say. Some of that is starting to come down, and you've seen that a little bit. But really, one of the key aspects that you have to keep control over, if your bulk commodities, those commodities that I mentioned, are actually pretty tight, and less of them being used in the design, that's clearly going to help negate the inflationary pressures we're seeing in the marketplace at the moment.
Yeah, I was just going to come in on there as well. In fund management, really, for the last 30 years, we've had globalization. And during globalization, for fund managers, clearly you've had periods of growth, and growth stocks done very well. When growth stocks weren't doing well, we saw, obviously, limited growth. Bond markets tended to go up. So most fund managers diversified from the mainstream funds, mainstream stocks, into uncorrelated assets, which was bond proxies. That just doesn't work with inflation. With inflation, both equities and bonds go up, down together. No diversification via bond proxies. You need diversification. The way to diversify is to get to physical assets. That's commodities, that's capital-intensive businesses. That does include things like property as well. So I think we're going to see a sea change in fund management from here.
Thank you.
Yeah, I just also wanted to chip in, I think, as what Tace was saying about human capital being a very scarce resource in the industry at the moment. And we're seeing cost blowouts on new projects that are way beyond inflation rates. It's got very little to do with inflation. It's got to do with the fact that there aren't enough people to build these things properly. And that is a concern for investors that are investing in new projects. Yeah,
I think whether that be lack of human resource or global supply chain crisis, that has been a significant concern in addition to inflation.
Yeah, it's a very small gene pool, as we all know, and there is no shortcut to get experience. And your human capital, your pool of human capital gets experience by building things, frankly, getting it wrong and learning from those mistakes. There's no shortcuts for that. So we've got a whole wave of new talent coming through, but it's going to take time to get the experience.
So moving on to the second question. So there's a rush around critical metals in order for countries to meet their net zero target and the whole energy transitions process. So how has the race to secure supply of critical metals driven the inflow from diverse sources of capital? So Alison, would you like to start with this?
Sure. I think there's certainly an appreciation amongst governments, amongst the ultimate users of those critical metals, and looking forward into the future and realizing the extent to which they will require those materials. That those new sources of capital are really having to get involved, where previously they may have sat back and just waited for the material to come to them. They're just the buyer. They don't need to go downstream and finance it. They don't need to, provide that kind of support to projects. So I think that's the opportunity, and I think people are aware of that. But there is a flip side of that as well, and I think it's the challenge. And the challenge is that traditionally in mining, your capital came from kind of, by and large, three places. It came from equity markets, it came from project financing, and it came from major mining companies stepping in and either JVing or buying out projects. And to a large extent in the energy transition materials, those sources of capitals are not coming to the party to the same extent. Major mining companies are very comfortable saying, I love energy transition, I'm so excited about it, I'm going to build more copper. They're not so excited about saying, I'm going to fund a graphite mine. They don't understand graphite. They don't know how it trades. They don't know how to bid it. They don't know the technology. So you see a kind of an absence of those players. Equally in project financing, and we spoke about this a little bit over tea earlier, you can't hedge it. You can't necessarily, your off-taker may or may not be bankable. Your off-take agreement may or may not be bankable. So it can be more difficult to secure some of those more traditional sources of financing in that space.
Yeah, I would agree with you. I think we're advising graphite company to raise funding, and we also work with the auto manufacturers that are looking for critical metals to go into the electrification initiatives they have. And in both cases, both the car manufacturers and on the graphite side, we're seeing people coming out of the woodwork that we haven't seen for years, the strategic stockpile guys in the US. And we're seeing, we've had approaches for those sort of materials where they rock up with they're four-star generals, they're out of the defense force and looking for raw materials. And so these guys, there are places that, have reactivated, started buying, getting involved in this, that haven't been in the business for many years. But the problem is exactly as we've talked about before, is that these guys haven't done it for the last 20 years. Life has moved on. The people that were there doing this in the old days are not there anymore. So these guys are having to relearn how to do all of this financing from scratch. I mean, the auto manufacturers used to be involved in PGM production and took shareholding and were involved in that. The defense, the strategic stockpile, the guys were involved in buying materials. But the guys that are doing it now are not those guys, and it's become very difficult to manage that. I mean, there's a certain amount of naivety and strange expectations, and so it has become complicated to do that.
Yeah, and because they're newly back in the game, and a lot of those players are not traditional investors in the mining space, don't have an appreciation for the timetable, how long it's going to take, how complex it is. And you see a lot of that under the IRA in the US, where they're proudly putting money to work, billions of dollars here or there, a couple of million here or there, and think that's all that's required. Just write a check and the metals are going to come next year. There's no appreciation for things like permitting, things like community support, things like you actually got to discover some of these ore bodies hasn't even been discovered yet. And then you got to go through all the study phases and you got to do the development and the funding. They think all it takes is writing a check. So I think there's going to be a lot of disappointment from a lot of those funders.
I think talking about decarbonization, communities, and all of that, there's a real focus around ESG and how, in terms of a mining industry, there's a need for decarbonization of industry, which might drive for more funding. Maybe, Thijs, would you like to shed some light on this?
Yeah, as I said, I think one of the biggest constraints continues to be that development pipeline, and ESG is what we call it today. It used to be called social license. It used to be bringing your communities along. It's not new. The industry has been paying attention to that, have been putting money and management time behind it for decades. But it is a lot more public now. Social media is obviously good and evil at the same time. A lot of stuff ends up on the front pages, and there's a lot of opposition against mining generally, because there is this perception. I saw this morning DiCaprio has jumped into the Cobre Panama debate now and backing. So there's a lot of this disconnect. On the one side, the metals is required to drive electrification of the globe, decarbonization, etc. But you still need the metal. Nobody wants that metal production in their backyards. So I think on the there is all the elements of ESG, if you want to call it that needs to be brought along. You need the community support. You need governmental support, Aboriginal, First Nations. There's no shortcuts to any of that. You got to do the right thing. You got to bring it along. The industry has been doing some of that, but I think that's just going to continue to slow down processes and slow down the pathway to production, which is none of that is going to be helpful to fulfilling the need for the metal production. There's things like recycling that there's a lot of talk around. But I think if you look at the numbers, supply-demand dynamics, and whether you believe in the sharp uptick in electric vehicles as an example, and the amount of metal that goes into there, recycling is just a drop in the bucket. It's not really going to move the dial over the next couple of decades. Maybe over time, and as batteries and electric vehicles come to the end of its useful life, repurposing is one direction, recycling is another. So maybe once there's bigger penetration of electric vehicles out in the market, maybe there's more batteries and maybe that will become material enough. At the moment, recycling isn't going to do it. So it's going to be primary production, and that gets impacted by all the basic fundamentals and steps you got to go through to get it off the ground.
Thank you. Gervais, would you like?
Yeah, I was just going to say, for fund managers, I mean, there's this sort of assumption that there's a right answer to ESG, when in fact it's just like everything else. You can invest in growth companies and income stocks and companies to do with long-term or international companies or local companies. Basically, we need this debate to actually get much more nuanced, and for different investors to have different choices in that area. So I think that's the first thing. The second thing is I think the fund management sector generally isn't doing a good job in this area. We've got a big separation between the people making the investment decisions on one side and then another team doing ESG in many cases and a lot of houses, and they make votes on the ESG side which might be different from what the fund manager wants. Complete nightmare. I think it's got to get more integrated.
Yeah, I think our experience recently in dealing with the big European banks is that ESG has become a huge thing in the bank, and is run separately from the mining teams. But more and more, the mining team is having to learn how the ESG guys work, and it's very much more driven by reporting and by filling out forms and so forth, as opposed to the real ESG. But nevertheless, I think where banks lead, the rest of the world will follow. I think investors, one way or another, are going to have to do that sort of thing, land up with enormously long forms that people will have to fill in before they're able to invest the funds.
Thank you for those insights. So another aspect that we talk about when we think about critical metal and investing is joint ventures and the vertical integration approach. Mark, would you maybe like to shed some light on this?
Yeah, as I said, we're in particular involved in the graphite industry, advising a graphite company to raise funds, and that's exactly what we're having to do. I mean, it's no longer in those sort of critical metals where it's you just mine a concentrate and sell a concentrate the way you would sell a copper concentrate or a copper cathode. I mean, the material coming out of there has got specific applications. The technology of using that concentrate is quite complicated. Even the step of converting a graphite concentrate into something you can stick into an anode is there's a lot of know-how involved. There's not rocket science, but there's a hell of a lot of know-how involved. And in order to do that, it's no good you try and invest that yourself. So guys are having to enter into joint ventures with technology partners to develop that, to have that skill available to be able to deliver into the market. Those joint ventures are becoming complicated because a lot of the technology in critical metals isn't in the West at the moment. It's coming out of China. For the very reason that the West wants to be less dependent on China, there's a complication around those sort of joint ventures. So it is becoming complex, but it's definitely something that is necessary.
Alison, would you like to add anything on this?
No, I mean, I just really echo that. You know, I think that in many investors' minds, there's this kind of ideal universe where your project is located in one of the safe kind of jurisdictions, or the jurisdictions that the US and Europe would ideally like to be pulling from. And all of the downstream steps are also located in those jurisdictions, but that entire value chain doesn't exist. So you're seeing quite a lot of mining companies trying to do the whole value chain themselves. They're quite different skill sets. And so you've already got the challenge of being a junior mining company that needs to raise money. But now you don't just need to raise money for a mine because you've convinced the market, don't worry, we're also going to do spherical, coated, whatever, you know, flake. And, you know, it's very technological. It's technologically complex, and it's additional layer of kind of risk. It's an additional layer of financing that needs to come.
Thank you. So moving on in terms of early stage projects at exploration stage, the early development, what are the challenges and observations that you have in terms of attracting significant investment at this crucial stage? Gervais, would you like to start?
Yeah, I mean, clearly my experience is mainly in quota companies. And quota companies, you know, they've sort of migrated up. People have become more interested in bigness, really. This is a globalization trend. Smallness has been out of fashion. Quoted smallness, clearly, very much out of fashion at the moment, as you know. So going forward, if you sort of separate the stock market, take the S&P index since 1900, basically it's had long periods when it's grown, returns have been better than inflation, like recently, the last 20 years or so. But most particularly, there are also periods, possibly 20 years, when returns are much less than inflation. Take the Japanese market for the last sort of 30 years or something. So there will be periods of change. I'm thinking we're entering a period of change. I think inflation is going to be higher. I think investment returns are going to be lower. I think basically most fund managers can buy as much as they like of the indices in the next, say, 10 or 20 years, and they'll make no money. And that forces a change of policy, and investors have to move down to smallness, quoted smallness. If that does happen, then the ability to actually finance early stage projects massively improves. I'm expecting that. I'm more optimistic about this than I've been for 30 years. And if it does start to happen, then obviously not only do you get obviously later stage projects, because you've got more early stage projects, but you get more opportunity to get some of those early gains, which can be very substantial and lucrative if you get capital following you into some of those early stage projects.
Yeah, I think if you had the answer to how to attract capital in this market, I think 90% of the CEOs out there would line up for that advice. So at the moment, nobody is interested. I think we can all see that. Whether it's good news or bad news coming out of news releases, stocks don't react to it. They tend to go down because it's a liquidity event. So I think clearly there's a bit of a longer term view and vision required from investors. Invest in the thematic rather than the near-term specifics, but that's nothing new. That's always been the case. I think for a lot of junior companies, it comes back to the human capital point again. I think teams who have proven to have been able to take projects through from discovery to development, and we know that's often not the same team, hand it over to the next one. Joint ventures, you mentioned. I think we've seen a number of M&A transactions recently where projects that clearly owned by somebody that doesn't either have the balance sheet or the team come together with another company with the balance sheet and the team. We've seen a number of those transactions. I think scale is clearly and risk diversification is clearly a key part of that equation. The days of just having to back a single asset and it's binary, whether that's going to get permitted and financed and developed. I mean, that makes a very tough investment decision, I'm sure. If you can actually make that decision around investing in a portfolio of projects and different commodities, maybe all are electrification focused, but at least some geographic diversification in there with a management team that you can back, with partners who've, again, have gone through the process before. Maybe you've got some operating cash flow you can leverage. They'll put Mark out of business, but that'll at least kind of level the playing field a little bit for attracting that capital, because at the moment, capital just doesn't seem to be really interested.
Sorry, I was just going to come into. I so disagree with you about it being a long-term thing. The whole point is the future isn't just made of smooth curves. The stock market is spiky, and it can spike like that. So we saw the recession came in with the pandemic. Small caps were the best performing sector, bar none, globally. So the month before, you wouldn't have seen it coming. The month after, it was just red hot. We don't know when it's coming. I think it's very soon.
Yeah, no, I think I was just going to agree with you to that. I was just going to say that, I think for funding for junior mining, for exploration stocks really comes from, the same kind of people who invest in weed and cryptocurrency stocks. And so, the fashions come and go, and it might not have anything to do with the fundamentals, but if weed's hot this week, and it doesn't matter if, resources are good and the long-term fundamentals are good, the money will just get sucked out, unfortunately.
Thank you. So next question, centering around constructing portfolio of investments. So today and looking forward, how are investors constructing their portfolio to best capture opportunities, and in which jurisdiction? Alison, would you like to start?
Sure. I mean, I think I'm delighted to hear Gervais's positive view on what might happen in the junior mining sector, because certainly what we've seen in this commodity cycle is that whilst commodity prices have run up and really, in some cases already peaked, traditionally what you would see at the end and towards the end of that cycle is the junior mining sector playing catch up and the small undeveloped projects really getting a run. And we kind of feel like we've missed it. So I think while we sit now and wait and look and see what is the long-term future for some of these niche and really key strategic commodities, you need the capital to be flowing into those sectors. And at some stage, that has to come to the party. And I think equity investors become aware of that. And there can be an opportunity there. However, I would say when we look at it against the backdrop that equity markets tend to be quite correlated. So it's quite difficult for a junior mining company that needs to raise quite a chunk of capital to push against those doors in an environment that may be more volatile for broader equity markets and the global economy.
Thank you, Gervais.
Yeah, and one of the features of a long period when equity markets are producing less return, Japan, etc., is that actually people need to actually get volatility. They actually need to buy volatility. They need to make not just 30% or 50%. They need the upside potential to be 3 times or 5 times. Again, this is going to change people's behavior. I think fund management industry is going to radically change, and people are going to have to embrace some of these opportunities, actually. So it's not happening now. I know that. It's actually really awful right now. I know that too. But the great thing is, market's spiky. It can just change tomorrow. I don't think it's going to be tomorrow. It may be the day after tomorrow, or maybe a couple of months out. Whatever, we don't know. But I think it's coming. I think it's imminent. The market's beautiful because it just puts everyone in a consensus position and then does what's most inconvenient for nearly everyone. Just think everyone's loaded up with these magic 6 or 7 stocks in the US. They're about to all underperform. The market's rubbish at pricing, risk of things becoming, obsolescence risk. Go back to 2000. Nokia was 250 billion market cap. It's nothing like that now. It's about 10 or something like that, right? There's an awful lot of change to come through. Remain quoted. The quoted market's the way forward.
I think one final question, conscious of the time. So, geopolitical consideration around portfolio strategy. So maybe, Mark, would you like to start?
No, I mean, first off, we don't have the luxury of constructing a portfolio. We find that we look for the best projects. There are not a lot of them, and we'll do them wherever they get done. The question then is just a question of managing the geopolitical risk. We're comfortable that if the project's structured properly, we've lent to the DRC and got our money back. We'll do it in Burkina. We've got money out in Burkina. So, I mean, I think managing the geopolitical risk is difficult, but if you're looking for good projects, you have to go where good resources are, and they're in inconvenient places, unfortunately.
Gervais?
Yeah, I've changed my behaviour in this area a lot. So for the last 10 or 20 years, I thought actually diversifying into just about any country was pretty acceptable. The whole point about globalisation was more people be inclusive. We are now ridiculously more careful, not so much about the country, of course there's risks associated with that. We now worry that quite a lot of the mainstream countries, sort of African countries and that kind of area, maybe some of the Asian countries, actually run out of hard currency. You've got a fantastic project, it delivers, you hit all your targets, you export all the metals, but the country itself doesn't have the hard currency to pay you, and so you can't pay your bills. For us, that's a serious risk going forward, and it's changed our behaviour.
So maybe before we move on to the questions, do you have any final words for our audience?
And for me, as a person of my age, if you can get a real job, get one. Otherwise, you're going to be doing this at my age.
Thank you. Alison?
No, I mean, the only thing I would say, and I know a lot of the people here are mining companies, so just be conscious that the market and your project don't necessarily maybe moving in opposite directions, but you always have to have the market in mind and be aware of what's happening in equity markets, because when you come to raise money, it's going to make a huge difference where the market is.
Nice.
Yeah, I think from a perspective, pick your partners well. And I think we talk a lot about equity financings. There's lots of other sources of financing out there these days, debt streaming, royalties. Pick your partners well, obviously your engineering execution partners. Work with your communities, work with your funding of sources. It becomes a game that everybody has to win together.
The other thing I would say is, actually, we're all salesmen at the end of the day. We need to sell everything. We need to sell, I certainly sell my funds. You need to sell your projects. Specifically, it's too easy to get kind of one presentation which does the analysts and the fund managers. No, they're different audiences. The analysts are interested in the detail and the fine detail of their models. Fund managers are interested in the bigger picture, not just the opportunity to make money, but the scale of the outcome. What's the range? Could it be this much, or could it be a lot more? So spend a lot of time, crafting your message. Sell really hard when you get the chance.
Thank you all. So now open. Any questions?
Hi, thank you. Thank you very much for the debate. My question really is, what do you think the next decade and a half, 2 decades, shareholders' view is going to be? Because I've sort of observed trends has changed about reinvestment of profits rather than distributions, and where the capital comes from. So I work with family office, I look at multi-generational wealth, and therefore I look at the compounding effect. But is the short-termism of shareholders, that trend is going to stay, or do you think we're going to go back to some multi-decade views, because mining ultimately is a long-term project?
I'll come in first. I mean, the whole point about markets which are moving fast is high beta works. In other words, volatility is good, momentum investing, all this stuff into some of the larger companies in the US, etc. Fine. Actually, when things get tough and money runs out, the only thing really matters is have you got any cash, right? So we're going to see a radical change. The FTSE 100 over the last 3 years is pretty much the best performing stock market in the world. Nobody's noticed. But it is already, right? And that's because the world's already changed. Most fund managers haven't changed. Most behavior hasn't changed yet, but that's already coming through. And that's with local investors selling local companies hand over fist. And it's still the best performing. So I think coming back to it, I think the world is going to change. Cash compounding is going to be the way forward. If you want to demonstrate you're generating cash, you're going to be paying dividends. Good and growing dividends, for me, is going to be the main issue. If you look at stock markets over 30 or 50 years, it's always the same. The only thing that makes any difference to your return is the initial yield you buy it and how much it changes. In other words, how much it grows. I think that's going to come back with spades.
Yeah, I mean, I must say, I think that if you look at what happened in the gold stock market, I think you've seen the split between the need for dividends, and the way to buy that is to buy royalties, buy the royalty companies who take out the dividends, whereas the gold companies themselves are the kind of guys that keep the money back. And to a large extent, the success of the royalty companies was driven by the desire of the gold companies to keep reinvesting rather than declaring dividends. So I think you'll see a split where you can start buying one or the other if you want.
Thank you. Any other questions?
Yeah. Do professional investors have some kind of benchmark or watermarks depending on the stage of development of the product in terms of market capitalization? Because what you typically see is that before reaching the $100 millions, I mean, you have to get to certificate 43101 or getting to preliminary economic analysis for the half billion, and then higher up, I mean, when the project becomes kind of either subject to M&A, acquisition target, or really prompt to get to production level, to commercial exploitation.
I mean, perhaps I'll come back on benchmarks, start with. Benchmarks at the moment are hugely important. You've got indexation, ETFs, all the rest of it. If benchmarks produce no return, suddenly they become an anchor. In other words, they don't go anywhere. You just wrap your arm around an anchor and go nowhere. It's going to be a complete nightmare being an index eventually, right? So the world's changing from where we are to where we're going, if I'm right. So basically, but what we do need as fund managers is, if we are investing in an early stage project, if there are other checks to be written in future, the nightmare for us isn't so much that we can write a check or that we can't write another check in a year's time or 3 years' time, whatever. The nightmare is that the rest of the fund, the shareholders, can't write a check and the company goes bust. So the reason why we're all so careful about writing really early stage checks isn't so much that we haven't got a great project. It's actually because we just don't know we can rely on the other shareholders to be there at the right time.
Alison?
I think I'll maybe jump in there and say, I think the way that you laid it out sort of makes sense. Like, you start early stage, and then as you go through the stages, you get bigger. But certainly our experience has been in some ways kind of the opposite, which is that things can get enormous amounts of excitement early stage if they're the right commodity in the right space that everyone's excited about. You know, we've seen lithium companies, some of them trading at hundreds of millions of dollars, and they haven't even really drilled yet. You know, but they're in the right place in the right time, and everyone's excited because it's in Canada, so it's the right space, it's the right geography, and it's the right commodity. And the flip side of that is companies that just stall. And I think that's part of what Gervais is saying. You know, when a company cannot move through the next stages of the funding, and particularly that huge hurdle of I need $300 million, it's a big amount of money. If you can't get it, you just stall. And so you can't kind of get to that next stage. So, you know, to some extent, it's not just a case of working through the cycle and the stages and developing the project. It's about making absolutely sure that you're strategically the right commodity in the right place, and that the market's going to kind of come to the party for that.
Any final question? No. Okay, well, thank you very much.